Hello and welcome back to Chapter 2. This is Learning Objective 3, preparing an income statement, including the cost of goods sold or COGS. So, friendly reminder that we have discussed in the previous video manufacturing products. So really, we have two types of companies. So zooming out, we have companies that manufacture things and companies that merchandise them. So if we think about a manufacturer, that could be items like Volkswagen. They build it and sell it. Apple, they build it and sell it. Midday squares, they bake them or square them and sell them. But the commonality between the car, the food, and the tech company is that they're all manufacturing these. They have the cost of producing their own goods, and they have the marketing of those goods and cost of sales. Then there's merchandising companies who take what other people produce and they market them. So they need to record the cost of purchasing the goods, not producing the goods, but purchasing the goods. And then they also have marketing costs as well. So this would be like Walmart. You go to Walmart, you buy toilet paper. You know Walmart didn't make the toilet paper. Even if it says Walmart on it. You know they just got like it's blue label and that they got somebody else to make it because there's no Walmart toilet paper, manufacturing plant. They are merchandising what other people are selling. Same with their Snickers bars, same with their clothes, same with their insert, whatever you see at Walmart here. And Best Buy. Now, please, when selecting these two, I'm pretty sure I was also wearing blue and yellow that day. Just what is in focus, I guess, is what you select. So in order to be a merchandising company, you don't need to have your colors be blue, white, and yellow. This is just a happy or weird coincidence. So Best Buy, you go in there, you buy a laptop. You know Best Buy didn't make the laptop, but they are merchandising it for you. So again, we either have manufacturing companies or we have merchandising companies. And within those two niches, we have different types of companies, like software as a service, SaaS, and whatnot. But then we can talk about the nuances. In general, at least for building this foundation, we're looking at manufacturing companies and merchandising companies. So same but different, put a different way. When we have our merchandiser, that is our Walmarts, our Best Buys, all companies have cash, receivables, prepaid expenses. But what makes these two different, our Walmart and Best Buys, from our Volkswagens, our Apple, our Midday Squares, is that the merchandiser buys inventory and sells it ideally for more. Like that's the whole point, is they buy it low, sell high, they buy in bulk, they sell, for some margin, meaning there's a difference between what they paid for it and what you're paying for it, and that's contributes to their profit. And then manufacturer, this is also like our Tim Hortons. They are getting the paper cups. They are getting they're shipping in the water, I don't know, or opening the tap. They are hopefully filtering it. They are grinding up the beans. They are having that work in process. My apologies. I put mine on airplane mode, and yeah, that is a persistent little alarm. Okay, let's just turn this entire thing off. Cool. By the way, I leave stuff like that in. This is real life. I also had a request to have these videos out. So if I thought it impacted the quality, sure, I go back in post-production, I'd find this little clip and I'd make myself a little bit more robotic, a little less, we have a chime going on in the background. But here we are. So we have our raw materials, then we have our ground coffee. It's a work in process. We have our finished coffee, which is finished for all of 2 seconds before it goes to our happy human. And various different other parts of inventories. I think it's likely easier to conceptualize if we think about it as in Volkswagen. We have the tires, we have the rims, we have we're putting steel into different parts of the car part, like the steel frame, other things. We have the glass that turns into a windshield and windows, and so on and so forth. A bunch of computer stuff. While it's being, they have raw materials, then it's being converted using manufacturing overhead and direct labor. That's a work in process as they put all the pieces of the car together. Then the cars are finished, they hang out, they look good, they're shipped from their plant to their storeroom, and eventually you buy them. So a lot more kind of goes on directly within the company when you're manufacturing. And as such, you have 3 different kind of stages of inventory. Your raw materials, your finished goods, and then the in-between part. And then, same for both. When they're sold, it moves from the inventory section to the income statement, okay, under cost of goods sold. So if we were to think about that in terms of a journal entry, that would look like debit cost of goods sold. Let's make that a little bit bigger. Debit cost of goods sold and credit inventory. You can be all fancy with a with a manufacturing company. You'd be like, ooh, that's a finished good inventory. Kind of think that's a little bit redundant unless that's specifically what the test is asking you to show. Because, and I say a little bit redundant because you know that it goes from a raw material to a work in process or a WIP to then a finished good. And we can't sell our WIP, right? So it literally goes from this T account. No marks for pretty, but I just want to give you all a little bit of border. No marks for pretty, and yet here I am. Boom. Formatting fun. What do we say? WIP. Finished good. Let's just keep the acronyms. Raw material. Cool. So we have some stuff. This, if we look at it as in a T account, where the debits are on the left and the credits are on the right, we have our borders. Boom. Okay. Usually a Microsoft lady, but here we go in Google because anyways, this is my recording computer. So we have our raw materials. We have that in, say we have $1,000 worth of cups, 1,000 zeros. They hang out there. Then all of a sudden we're like, sweet, we're gonna turn the cups, let's make it $1,000 or $10,000 worth of glass. Let's go back to our Volkswagen, $10,000 worth of glass. Then we decide we're gonna be moving them. So this is at the beginning of the year. Then we're gonna be starting to use them. We would credit that and move it to our work in process. So then we have a whole bunch of things in work in process. This is our raw materials, glass. We'll also have raw materials, I don't know, tires, raw materials, steel, raw materials, bunch of different buckets. And then we move all of them as we start using them to the work in process. So we'll have the 10,000 from the tires or the glass, the yada yada. This would be a bigger number. So this ends up being a bunch of other debits and credit, or pardon me, a bunch of other debits because they're moving in, we're working on it. So you can imagine the other accounts there. All of a sudden, say we finish all of our products, just all of them. We just make all the cars. Feel free to imagine a couple extra zeros on there. And we finish them all, and they are no longer a work in process, so they get transferred out. We credit them. And where do they go? Well, they go to our inventory. And so this is almost like as if they're on a shelf, although cars would be too big to be on a shelf. This is where they'll go. So when we buy the raw materials, we debit raw materials and we credit either likely cash or AP, so cash or AP, accounts payable. And then in order to move it to WIP, we are going to be debiting our WIP, so moving it there, moving it from raw materials for that 10,000 here. Debits equal credits, debits equal credits. And then part of all of this, we would do just one journal entry for all of them. Debit the finished goods for our 85,000. Credit our WIP. Work in process for the 85,000. Such that at the end, under It's a rule. If you don't talk to Excel, it doesn't do it for you. Under. This is going to be 0 because we used all of our glass. This is going to be 0 because we have nothing else that we're working on. This is at the end of the year. That's why there's little boom, end of the year, end of the year. And then here, this is going to be 85,000 because we have $85,000 worth of things at the end of the year that are not sold. Cars, cups, etc. Okay, so all of this raw materials is inventory. This is inventory. This is inventory. Raw materials. This is inventory. This is inventory. So what we've done is we've just looked at all of our things under inventory. So on our balance sheet, this will likely just look as one. But as you know, it's not just one, right? The story for management accountants is a little bit deeper. You know, we got the raw materials, we converted them, or in the process of converting them, and then we stuck them on our shelves or our storerooms and are waiting to sell them. So merchandising companies like Walmart would just go out and they would say, hey, let's go buy some stuff. Let's go buy some PX3s or 5s or whatever, you know, your old one. And sure, they bought them for cash or accounts payable. When in doubt, sure, cash. And so Walmart, the merchandising company, is nice and simple. Debit inventory, credit cash. Here, these are all inventory accounts for our manufacturing company, but they're all sub-accounts that roll up to the same inventory. So when, how do I say this? When you are an inventory accountant, say that is like your first job or second job, and you are working in a company, they would typically pay somebody at a manufacturing company more money to do manufacturing inventory accounting than they would at, say, a merchandising company, because it is more involved. As you will see in the next several chapters, we have lots of nuances within this framework. So feel free to come back. I did invest some time in this video to go through some journal entries to continue to lay the foundation, because this will be a theme that we build on in subsequent videos. Okay. So this all goes on our balance sheet. Then we have our income statement. Now I realize there's some numbers here. I left them here for a reason, but all of this kind of mirrors what I just did in the T accounts for you. So if we first look at the merchandising company, cost of goods sold, again, this is on the income statement. We are looking at what did they actually sell throughout the year. And what they actually sold throughout the year is what was moved from, let's just make some T accounts. This is their inventory, T account. And this is the beginning of the year. They have 0 at the beginning of the year. Then they had some purchases. They had purchases of, say, 25,000. Then they end the year with 10,000. What did they sell? What was their cost of goods sold? Well, for the merchandising company, again, they have the one big overarching inventory account. We can look at what was in their inventory. So in equals beginning plus purchases. And here, in equals 25,000. Great. And then in general, not in general, pardon me, in always, because it's a closed system, in equals out. And when we talk about what is out, we're talking about what is available. So out equals what's available for sale. And what's available was in our ending inventory, plus what our cost of goods sold are. So whether or not you want to use this formula or the T account, we can see that in order to solve for COGS, COGS is going to be out minus ending inventory, or because out equals in minus, sorry, yeah, because I moved that here, out minus ending, yep, sorry, in minus ending, and we're told that in was the 25,000, right? The 0 plus the 25,000 is equal to the 25,000 minus the ending, which is 10,000. So we know that COGS equals 15,123. If we do our formula, in equals out. And then let's plug it in here and see if the T account balances for our cost of goods sold. Let's see, we add up our debits, 25,000, we minus our credits, 15,000, and that gives us ending inventory of 10,000. All right, so circling back to our slides, we then can see that the manufacturing company, while they'll use different names here, it's really similar if we dig into it a little bit and just understand what our overarching items are, right? So we go from raw materials to work in process to finished goods. So we're really looking at what went from work in process to finished goods. This transaction would be similar to the purchases, except they manufactured them. So instead of purchasing, they manufactured them to go into this bucket. So when we look back at our slides, we start with beginning finished goods, so what's on our floor room, plus what's the cost of goods manufactured, that is what is transferred in from our WIP, work in process, because it's finished, and that's our in. Our in for a manufacturing company is the total goods available for sale, that's what is on our shelves. Then we minus our out, so in equals out, we minus our finished goods inventory, and that equals our cost of goods sold. So whether or not we are looking at a manufacturing company or a merchandising company, when we go from our finished goods to our inventory, that is cost of goods manufactured, and that's just like us purchasing it from externally if we were to parallel that with a merchandising company. Okay. So again, as I mentioned in a recent discussion board post, learning is repeated exposure to same or similar materials. This is why this course is broken down with lots of learning resources, but they're meant to be kind of done and then put down, and then done and then put down in little small chunks. So mini lecture videos per learning objective, 80-minute tutorials are probably the longest stint that you'll be, but you'll work up to that, right? You'll read part of a chapter, do part of the pre-work, read the chapter, do the pre-work, read the chapter, do the pre-work. Perhaps you do read the entire chapter, do the entire pre-work, but they're kind of smaller bits. Then watch the mini lecture videos and you're building on it. Then you're doing some practice problems. Then you're doing tutorial. Then you're going back and doing some more practice problems. Then you're prepping for the different quizzes or term tests. So they're meant to be like little mini exposures, so repeated learning versus sitting down and trying to get all of this in one go, because it really is getting used to that new language of accounting. Okay, in manufacturing accounting, so our managerial accounting. So I added this slide because I really think it's important for me at least to share with you how I remember all of this stuff, whether or not we're talking about merchandising or manufacturing. What we start with plus what we add has to equal what we end with and what is removed. In other words, in equals out. Visually speaking, you start with a bunch of margarine or butter, your choice, and whatever's in on the shelves, cool, that was your beginning balance. Then you have someone who adds the new stuff, the additions to inventory, whether that's because they purchased more or whether or not they went to the back and made more butter, put it on the shelves. All of this is available to sale because it's there. It's what's in, it's what's available. Then you can reverse engineer. If you have how much was withdrawal from your inventory, then you know how much you have left. So if you know what you started with plus your additions, if you know it was available for sale, and then you go at the end of the month and you count up, oh, we have 5 left, cool. Then you know how much you were sold. Conversely, if you know how much you were sold, you go to the cash register, you see how much butter you sold, then you know what your ending balance should be on the shelf. And I say should be because if somebody stole some butter, obviously it wouldn't show up in the cash register, but you can kind of see what your anticipated inventory balance is. If that just excited you a little bit, like being like, ooh, is what we have recorded equal to what we actually have, then I will drop a little promo for an auditor. Definitely not lots, but like a portion of what you do is kind of seeing, is what was recorded actually there? So if that's for you, consider doing third year, an accounting course in financial statement analysis, managerial accounting, and consider possibly doing accounting as your major. Don't worry, this isn't going to turn into a giant promo. I'm just saying that that's part of the audit aspect of this. All right, time for a quick check. If the monthly balance at the beginning of the month was $1,000, $100 of inventory was bought during the month, and $300 of inventory was sold during the month, what would that inventory balance be at the end of the month? Please give this a pause, and I'll see you back in just a second. All right, so let us think in equals out. And what is in? In equals beginning plus purchases. Out equals cost of goods sold. I know. I guess I could say C, but we're just going to do this. Plus ending. All right, now let us plug in our numbers. I like when people are like, ooh, accounting, it's really hard math. I'm like, accounting is hard. I wouldn't say it's hard math. It's hard. But the math part is like the fun part. I'm like, can you add and subtract? Then you can accountant. Which is a little bit of a bummer for me. I was almost a math major in university, but hey, don't worry. If you don't use it, you do, in fact, lose it. Beginning balance at the beginning of the month was 1,000. Cool. 1,000, done. And then we bought some stuff, bought it 100. Okay. So what do we have available? We have 1,100. Cool. I will just do that here. So we have 1,100, and that is what is available for sale or are in. Awesome. Okay, and then $300 of the inventory was sold at the end of the month. Okay, so we know that our out equals 1,100, because out equals in, minus our cost of goods sold, our cost of goods sold, sorry, our out equals our in, sorry, I was getting all fancy on you. Okay, so we know that we have 1,100 available for sale, which is our in. We know that our out is equal to our 300, which is our cost of goods sold, and our ending inventory. So we know that in equals out, or 1,100 is equal to 300 plus ending inventory. In order to solve for E, we need to have 1,100 minus 300, and our E, or our ending inventory is 800. So if you selected B, then you have the correct answer. Boom. Awesome. In equals out. Otherwise known as solving for that equation, because we know that what you start with plus what you add minus either what's sold or what's left, and you can solve for that remaining variable. Cool. Well, thank you so much for your attention. I will see you in the next video.